Advanced funding the business. In funding the business, there are two primary sources of finance available to the business: debt and equity. The advantage of equity funding to a business is that it does not have to pay the shareholder an income in the form of a dividend and does not have to return the capital. It is therefore of lower risk to the business, but higher risk to the investor. The income to the provider of debt, on the other hand, must be paid in the form of interest, as must the capital that has been borrowed. Debt is therefore of higher risk to the business, but lower risk to the investor. As a result, providers of equity will demand a greater return on investment to compensate them for the additional risk that they are taking on. We can now take these two sources of funding a stage further: debt and equity. Together make the capital employed in the business. Let's look at equity in more detail. Early stage funding comes from venture capitalists, such as business angels, who provide seed capital and equity funding to businesses when they start or in their early years. But venture capitalists want to realize their investments. As the companies they have invested in are private, there is no ready market for the shares in which to sell. They need to create this market. One way they might achieve this is via an IPO, or an initial public offering or flotation. When a company floats, it creates a ready market for the shares and allows the venture capitalist investors to sell their shares. M&A stands for mergers and acquisitions, companies buying companies and companies selling companies as part of their ongoing changing business strategies. Private equity involves taking companies private or delisting them. Private equity funds tend to buy more mature businesses, but as equity investors, they're still looking to realize their investments. So private equity is very similar to venture capital. They're looking to generate an income from their investments, but the ultimate aim is to realize their investment by selling their shares to other parties. On the other side, we have debt. Debt can be divided into loans and into bonds. What's the difference between a loan and a bond? Essentially, a bond is a tradable loan. Whereas stocks and shares are traded on the stock market, bonds are traded on the bond market. Which is bigger? Well, it's tempting to say the stock market, as we read about them every day in the newspapers. The Dow Jones, the S&P, the Nasdaq, the CAC, the DAX, the FTSE, the Hang Seng, the Nikkei, and so on. But in actual fact, the bond markets are much, much bigger. So why do we not read about them in the news so much? The reason is that prices in the stock markets are much more volatile, so there is much more to report. Let's now look at loans in a little bit more detail. If you wanted to borrow $100,000 from me, then that should not be a problem. But if you want to borrow $100 million, then the bank will probably syndicate the loan. In effect, that's to get a group of banks together to lend you the money, to spread the risk. If you wanted to buy an asset rather than lending you the money and finding that you may have spent it elsewhere in the business, the bank might choose to buy the asset for you. Again, this de-risks the loan from the bank's perspective. And if you want to build a new motorway or airport, the bank might use project finance, in effect lending money to the project rather than to the company running the project. This way, the income from the project can be used to repay the loan. Over on the bond side, short-term bonds are called commercial paper or certificates of deposit. These are loans to companies that must be repaid in a short period of time. Medium-term bonds are payable up to a year, and long-term bonds can be repaid for as long as you want, 5, 10, 15, even 100 years. If you lend to a company for 100 years, then it is a bet as much as anything else that the company will be around in 100 years to repay that bond. Why would you lend to a company for 100 years on the assumption that you will not be around in 100 years to collect on the debt? Well, the reason is you can trade the loan on to somebody else in the market who will be around then. Securitization is the process of packaging up loans and turning them into bonds. Underneath all of this, we have the murky and often misunderstood world of derivatives. So what is a derivative? A derivative is defined as a contract between two parties where neither party owns the thing that is being bought or sold. It derives its value from an underlying asset class. A derivative is a contract between two parties where neither party owns the thing that is being bought or sold. It derives its value from an underlying asset class. Now, if you're thinking that this definition does not make derivatives any clearer, then that would be fair enough. So let's look at an example. Here's Arthur. Arthur is in the United States and is looking to make a trip to Europe. He's told that the cost of the trip will be $5,000 and that he can pay in a year's time when he makes the trip, which is good as this will help his cash flow. Let us assume that today's exchange rate is 1-to-1, i.e. $1 will buy €1. Arthur calculates that the trip will cost him $5,000 and this is within his budget, so he's happy. But then Arthur gets to thinking, what if in 1 year's time $1 will only buy half a euro? In this case, the trip will cost him $10,000. This is outside his budget, so he will not be happy. So what to do? Arthur could pay for the trip today, but that would have an adverse effect on his cash flow. He therefore decides to enter into a future contract with his bank. A future is a contract between two parties, in Arthur's case, to buy or to sell in the bank's case at a future point in time. Arthur has limited his risk of an adverse currency movement, but he has not had to buy the whole 5,000 euros today. From the bank's perspective, it's not a problem, as they've just been on the phone to a Frenchman who wants to visit the USA in a year's time and wanted the reverse deal, so the bank can hedge the two against each other. So Arthur is happy with his future contract. But then he gets to thinking, this is all well and good to protect him from an adverse movement in the exchange rate, but what if in 1 year's time $1 will buy €2? In that case, the trip would cost him $2,500, but he's entered into a future contract that means he definitely has to pay $5,000. So in this case, he would not be happy. So therefore, Arthur might consider entering into an option. An option is the right, in Arthur's case, to buy or to sell at a future point in time. With an option contract, he is better off buying the dollars from the bank, then Arthur will do so. Otherwise, if he is better off buying from a travel agent, then he will buy them from the travel agent and the option contract will lapse worthless. The option contract represents a significant transfer of risk from Arthur to the bank, and so will cost Arthur more. And so he is happy. And so we can see that companies that are trading in multiple currencies around the world need to use currency derivatives to manage their exposure to adverse exchange risks. Because if you're selling something in yen but buying it in dollars, you are exposed to exchange rate risks as well as all the other normal risks associated with doing business. Let's return to Arthur. Arthur is now thinking about the airline which is going to fly him to Europe. The biggest cost to the airline of flying Arthur to Europe is the fuel. So how much will it cost the airline to fill up? No one knows, because no one can accurately predict the future price of fuel in a year's time. So how can the airline price the seat today and guarantee to make a profit on the flight in a year's time? The answer is that it will buy the fuel on the future or options market. And so now we can see that commodities, hard commodities such as copper, gold, silver, iron, uranium, and soft commodities such as sugar, wheat, barley, corn, maize, coffee, cocoa are all traded on the futures and options market. Even the weather is traded. Now let us consider the last category of derivatives. Imagine that Arthur has a house and that Ben also has a house. Both have mortgages with which they use to buy their houses. Arthur has a fixed rate mortgage and Ben has a variable rate mortgage. For reasons best known to each of them, Arthur now wants a variable rate and Ben now wants a fixed rate. Remember, whenever there's a trade in the market, there are two sides to that trade, a buyer and a seller. Arthur and Ben could go back to their respective banks and renegotiate their mortgage agreements, but this would be very costly and take a lot of time. So what they might choose to do is to swap their interest streams. Arthur agrees to pay the interest on Ben's mortgage and Ben agrees to pay the interest on Arthur's mortgage. They keep their houses and their mortgage products and merely swap the interest streams. And so now we can see what derivatives are and consider the three main categories of derivatives. The market in derivatives is enormous, around 10 times the size of the market in bonds. And that is how businesses are funded.